Okay, how's everybody? Woo. Thank you, Phenix, and Chantal, Laura, our panelists, and you all for today. Can everybody hear me, by the way? It's all good? I'm excited to be here. I'm a little risk. I just, you ever go to ChatGPT or any of the AI and you say, write me a joke? So I just said one, I did a couple, but there's some are a little too long, but they're slightly funny. But a real quick one. Why did the horse, a solar panel, and an oil rig cross the road? Because they were on the way to the Energy Transition Conference. That's what it said. Boom, 1 second. Anyhow, I'm really excited for this panel, and Sean, really enjoyed hearing what you talked in your passion. We are going to touch a little bit on environmental justice as well, and I'm glad you mentioned the IRA because it's and other things that we were doing in this country and similar things overseas to help with this transition. Today we're going to explore the energy transition, and we're going to cover both environmental and economic, but we're going to really spend more time on the investment side of things, investment/economic. What our goal is to provide a roadmap to you all from an investment point of view, and especially how you can allocate your resources and create a meaningful impact in the space. The U.S. energy transition is in the shift from fossil fuels to clean energy resources, including renewable and nuclear, which you all know. And it's driven by a number of factors all coming together: climate change, economic opportunities, technological advances, geopolitical issues, et cetera. But you really think about it, increased investment in renewable energy, decreasing use of things like coal, and growth of electrical vehicle market. So we'll be covering some of those this morning. First, what we're going to do is to talk at a high level just about the energy transition from our panelists' point of view, including some of the trends from the IRA and other similar policies. We're going to spend most of the time in the second part, which will be on pragmatic ways investors can allocate their capital to the space. And finally, we'll address the economic and environmental justice benefits from this transition. But quick question, are we doing questions or no? I didn't get that. Okay. If you have a burning question, raise your hand, and maybe we'll take it towards the end if we have time. So first, we're going to just to introduce ourselves. I'm going to ask the panelists to introduce their name, their title, what they do, and it's most especially what makes them passionate about their work. We'll start with Anna.
All right, we'll start with the person with the most ridiculously long title. As it says here, I work at a small firm called Bank of America, and I work on the wealth management side, so I actually run investment selection across all asset classes for the firm, which just basically means I pick the funds that our clients can invest in. And in the context of that role, I started the Sustainable and Impact Investing platform about 10 years ago, about $50 billion under that now.
Hi, I'm Erica Bryce. I may have you on the title link, maybe? I'm not sure. So I am an investment officer in the social investment practice at Kresge. And so we are an impact-first investor. Kresge Foundation is a legacy foundation. And how we do our work is we look first to what our program teams are doing, which are the grant-making teams, and then they inform what we do as investment officers. I tell people there are 2.5 of me. I'm assigned to the health team and the human services team. I have another colleague that is assigned to environment. However, we're taking a whole Kresge approach, and so every team is touching upon environment, and I'm happy to talk about that today.
First of all, Phenix Capital, thank you for having us. I'm Kunal Doshi. I'm the Chief Investment Officer at Accelerate Investment Group. We mostly work with foundations, family offices, institutions to help them not only carve out portfolios for sustainability, but also fundamentally manage their capital as they transition towards a more sustainable economy and a portfolio.
And I'm Tyler Blickhand, Associate Director of Investments for Ascension Investment Management. We're a wholly owned subsidiary of Ascension Health, a national Catholic healthcare organization. Within that, I focus on what we do for private market investing as well as impact investing with a Catholic lens. And kind of getting to your one question about what makes me passionate about this. With impact investing, we've been doing it for about 10 years, similar to Anna. The thing that makes me most passionate right now is from where we started with the opportunity set 10 years ago, where sometimes I had to decide between a manager who I thought they have a really good heart and they want to do impact, but I don't know if they have the investment skill, and managers where it's like, well, if we squint, maybe this feels like they're going to have a positive impact. We're now seeing so much talent that has real investment rigor and a real passion for impact coming into the space, and I think that'll go towards some of the conversation today about how that's evolved, both on an opportunity set to have impact and achieve really good returns for our organizations underneath as well.
Yeah, thanks for mentioning that, and I know that the group is all very passionate about this space. What's really, I think, cool about this industry, the impact industry, is that everybody we meet is it's collaborative, people are excited. I think you all, you want to move into this thing. Maybe you've been in it a while, or maybe you're just coming into it, but I think it's very different than other parts of the finance industry, which have different motivations and also good collaboration, but the impact industry is a really good place to be for a lot of reasons. Okay, so we're going to go about 5,000 feet off of sea level. And Kunal, you want to start here about maybe the energy transition from your point of view, but we want all the panelists to pepper in here. Talk about it. What are you seeing? What's your sense of things? What are the tailwinds? We can touch upon things, the Inflation Reduction Act and other, and then we'll have a follow-up question.
Sure, happy to. This year, 2022 in particular, has been an overall win. We've invested about $1.1 trillion into the clean energy transition. And to give you an example of how that correlates, that matches for the first time the amount of investment we made in fossil fuel industry. In spite of the fact that last year we increased our investment in fossil fuel because of the fact that there was a global energy crisis. That being said, in order to get to net zero by 2050, we need to still triple our investment, which to me means there's a lot of opportunity. The way I summarize this, when I think of where 2023 is going in the global energy crisis, I was with a family office yesterday, and for some reason they decided to choose a bar where you can throw axes. And to me, that just fundamentally described the direction, the political scenario, the geopolitical instability, which is what a great idea to give a bunch of people who are drinking beer axes to throw. And that's fundamentally how things have been going. When you look at the IRA, the fundamental goal of the IRA was, A, to shift our focus on 80% clean energy, to reduce carbon pollution by 40%. And to do that, there are about $370 billion in incentives. So regardless of whether you're a person who believes in doing good, regardless of whether you're a person who believes in impact investing, because even the word impact investing is up for debate, fundamentally, you as a good investor should be taking advantage of those tailwinds, right? And there are 5 sectors that I would argue are worth looking into. One is manufacturing. With geopolitical risk and increasing tensions with China, you're going to see more and more of a shift towards the local economy. The second thing is electrifying transportation. So this is already done. Internal combustion engine sales peaked in 2017. With a $7,500 federal rebate for used and new renewable cars, it's going to only get better in the long term. The third sector to look at is sort of greener buildings. Buildings account for 1/3 of the global emissions. Fourth, you could take a look at decarbonizing electricity itself. The good news is for the first 5 months of 2023, solar and wind alone produce more power than coal for the first time in the United States. And lastly, there are tough to abate industries like steel, cement, and those are worth paying attention to. So as you think of your portfolio, as you think of where you want to generate an alpha over the next decade, I'd pay attention to some of those subsectors.
Thank you. I love the optimism, by the way. I think that the more we frame all this as just the biggest mega trend of our lives, I think it's just better for all of us, for our psyche as well. Who wants to go next? Okay, Erica.
Piggyback. So I'm so glad you talked about steel and things in manufacturing. So Kresge has been broadly known for a lot of our work in solar. wanting to ensure that low-income people across the country have access to all the climate adaptation tools, energy transition tools that they can have, right? We want to make sure that it's possible. We've also done a lot to support our grantees in driving policy. So the Justice 40 initiative, which basically says that I think roughly 40% of the IRA benefits need to also benefit low-income communities. You also add on top of that the Greenhouse Gas Reduction Act, GGRF. I never say it like in the right order, but is another major opportunity there where we're looking at how you funnel those dollars into CDFIs, banks, credit unions, so that there can be money on the ground. But another way that we've been looking at this actually really is on the supplier side. A lot of the cities that we serve are cities that are probably Rust Belt a little bit, have some industrial assets that we think could be part of the energy transition, but particularly because they're in low-income communities, in communities that have been left behind and are not necessarily thought of as being a productive part of the United States or a productive part of our economy. So we made an investment in the 22 fund, was one investment, and it's a private manufacturing fund, private equity manufacturing fund. But they have a focus on clean tech and climate tech, and they have a focus on diverse manufacturers that are small and medium size. So I'm not saying that to pitch them, I'm saying for us as an impact investor, we saw an opportunity to support a company that is intentionally making sure that they are including parts of our economy that, or a country that are not usually thought of as part of the energy transition. And we think there's a real opportunity there too on the manufacturing side.
Thank you. And if you've studied the Inflation Reduction Act, you'll see that it's written in there about capital having to flow to areas for economic, and climate justice. And a lot of those communities get hurt by the old energy system. So I think it was great that they really put it in the bill itself. And lots happening, especially with work that you all are doing and others. Anna, do you want to add on this?
I think that we're extremely positive, and I agree, Kunal. We're not the only people, and many people are touting this as the investment opportunity of our lifetimes. Mm-hmm. I held up the green or whatever. One of the things around the knowledge base in this, and being a challenge in this space. And I think that while there's a lot of new capital going in, the issue really is around reallocation of capital. And, I would say that's the other side of the coin that I'm not as excited about in terms of seeing real progress. I think that the majority of the institutional world, sort of under the guise of being fiduciaries, use the E, right, as a, only through the lens of risk mitigation. And then they go like that. P.S. Every time you sell something and there's someone who buys it, that's not, you're just transferring the risk. You're not actually mitigating it for the system. Anyway, longer story. But this, I was excited for this panel because we're going to be talking about the actual opportunities, right? And I really want to look at, let's talk about where new investment needs to go, but also how to reallocate capital, because we're not, doing a 4x times 1.3 trillion, which I think is what the IEA's latest report said that we need to do without reallocation of capital across all asset classes. So,
yeah. I think to piggyback on that a little bit, to be a little bit of a wet blanket on some of this too is, also understand what the IRA might mean in terms of there's more capital coming in. That might lower return expectations that you should expect around some of these areas because they are kind of lowering the overall risk level. So compared to what we saw over the last 10 years for people who were doing a really good job building out solar and wind, I heard one credit group talk about they're a little worried about overbuild of manufacturing. I think sometimes, especially we've already seen it in climate, a win on the impact side might just mean not necessarily a loss, but just a less of a win on the return side. So just be aware of some of these areas that are going to have really strong tailwind support. Probably going to still lead to really good overall nominal returns, but those levels might be lower because the risk level has also been lowered. I also think one of the other areas we're excited about, but just know that IRA is probably not going to have a lot of impact on some of the venture investments you're making at this point. It's really focused on having kind of immediate action going in. So you already have to prove that you're reducing greenhouse gases. You already need to be doing some things at scale. So if you have some later stage venture, maybe it gets there, but a lot of it is focused on things that are already happening now, maybe a little bit more than some of the new innovation that's happening at this point and hasn't had time to scale up yet.
That's a really good point, and I think if you looked at like the trend of what's already been done in renewables, the returns are going to go down anyways, IRA or not. It just was occurring, but maybe more risk adjusted now, and still positive returns. Then and then the technology that is just going like this in everything, along with onshoring that'll occur, and industries that we just haven't been in at all. So a lot of build out that's going to help the real economy, and then sort of matriculate into the investment world as also. Perfect. Any quick question on this one? Okay. Let's go to the second part, and this will be more in-depth discussion, but it's about capital allocation. So if you think about yourself, and you're institutional investors here, as well as high net worth, ultra high net worth investors, and other kinds of investors. So you all have your ways of investing, and whether or not you're in the space or looking at the space, I think this group can give us ideas about how do you consider allocating capital in this area, how they're doing it, different kinds of opportunities. So why don't we start with Anna?
Yeah, so the way that we're talking to our clients about looking at the energy transition is not just sort of focusing on one asset class, and I know impact investors like to say that the only place that you can have impact is in the private markets, and that is true in a sort of, if you're thinking about like a controlled position and how you can influence that position when you actually own a company. But there is a huge amount of, and there's but beyond sort of private equity and that model that people sort of associate with impact, right? The majority of flows right now in private market space are into credit and real estate, and I would say that largely, and I'm like present company excluded for any fund manager who does this, because I know everyone will run up to me and tell me that they do this, but present company excluded, the majority of private credit and private real estate assets that are getting flows, right, do not have really an environmental strategy attached to them. So that's one thing that we are trying to figure out, right, because that is like where the flows are going. And the fact that, you have people that have some loose net zero type of commitments, but really sort of a strategy to decarbonize those assets, or really to think about sort of lending in the context in the private credit space, which has actually, filled a hole and will probably fill more holes as sort of smaller banks have come out of the market. That is a space that is really ripe, right, for innovation, and where we're really sort of focusing a lot of our time. Certainly, sticking on private markets, the infrastructure space. What I am really excited to see is so many more sustainable focused infrastructure funds. When I first did this search like 10 years ago, like there would be a little sleeve, little renewable energy sleeve somewhere in these large infrastructure funds that were, maybe it was a 10% sleeve, and now the opportunity set, and actually it's not because people just sort of woke up, but actually the industry has matured so that you can have mega infrastructure funds that are sustainable and impact focused, right? Given the opportunity that Kunal was talking about before. But on my side, like the majority of the sustainable and impact assets that we have are public markets, are in the public markets, because most people have about 60% in equities and 40% in public bonds, right? And a little sliver in private markets, like the average individual and institutional account. And so we are as focused on figuring out how to, like I said, reallocate, so strategies towards the energy transition, and we have a whole map, right, that goes from, I mean, they're not my favorite, but like, you know, low carbon ETFs, right? Somewhat of a blunt instrument, I would say, but to, you know, to resource efficient strategies, to outcome oriented strategies, right? Strategies that are investing in publicly traded solutions based, you know, environmental solutions based investments. And then, you know, we have a lot of taxable clients, so I know many of you may not be, but on the institutional side, but the U.S. muni market is actually one of the most interesting places where you're seeing and where you're seeing sort of energy transition deals take place. And the more that those investments, the more that gets capital that flows into those types of investments, the more municipalities, right, are encouraged, right, to offer these. And so, you know, beyond the green bond market, which is a great opportunity, right, and growing, and a mature market at this point, which happened actually quite quickly. You know, the muni markets are also a place that we're, so we think that you can activate this across your entire portfolio, and you don't need to be just sort of looking at some sliver of your energy to invest in the energy transition. And that's neat. I mean, this systemic change, right, where you know, in the public markets, the theory of change is different than in the private markets, right? The public markets, you want to redirect large parts of capital, right, towards this, and you need to do that in a very different way than you can in the private markets. So that's how we see it.
Anna, thank you. I think when you were talking about that, I'm laughing because 2 years ago when someone asked me a question about how do you allocate on a sustainable basis, I explained the strategy, and then they said, why do you believe in woke capitalism? And 2 years ago, I didn't know what that term meant, so I dodged the question, and I went home and Googled what woke means. And it basically means alert, you're awake. I was like, yeah, as an investor, why wouldn't you want to be alert? Like this, the whole terminology, the whole pushback, to me, just means that the strategy is working. And those that are unable or unwilling to work around it, those companies, those investment firms will face the biggest risk. Yeah. Well, as those institutions that can catalyze on the fact that this is a global sustainable challenge, that climate change, environmental pollution, natural resource constraints is a fact, and you can develop and adapt your strategy around it, you will be positioned for growth. And as you think about your portfolio allocation across when you work with clients, you're absolutely right, a lot of them are allocated on the public side. Some of them struggle with access on the private side because it's harder to diligence. There's lack of transparency. But the simple process to go about with it is first just understand how do you define impact. As much of standardization is going on, every institution, every individual will care about certain aspects of impact more than the others. The second is look at your own portfolio. Which companies are managing ESG risks properly? Which fund managers are aligning themselves to ESG? And which fund managers are unintentionally aligning themselves to ESG? Because at the end of the day, it's just a lens of investing. And a good investment is a good investment. Thirdly, then think about the optionality, right? Like Anna mentioned a couple of different options out there. Think what matches your risk-return profile, your geographical preferences, your timeline, and then ultimately design a portfolio that doesn't transition overnight. It's like surfing a wave. If you're too early or too late, it's going to hurt you. Like you got to make sure the transition happens over the next decade as you slowly get to net zero.
Can I just sort of, because we've had a really big debate internally around like, is impact investing the client preference, right? Or is it an investment imperative? I would say in this case, and in many other cases in the impact space, like I say to client, and of course I care about what my client's preference is, but you hire me because I'm the investment professional, and I am telling you this is the biggest risk and the biggest opportunity. I don't give two whatevers about what your preferences are, right? Like if we're investment professionals, right, and you hire me, you pay me money to tell you where to avoid and what to invest in, right? I'm a very hard liner on this, but you know, like I just think like we like. you know, like that to me is just a line in the sand at this point, right? We can't like,
Yeah.
I agree. I agree. I mean, so, you know, I work for Kresge. I'm on the PRI side. Our endowment also has a very clear viewpoint on investing in the energy transition economy. Sometimes that does seem to counter our grant-making side. I'm also a pension fund trustee. Facts are there. So, I mean, I can't really argue with the facts and where we want to operate in perpetuity. If we're going to operate in perpetuity, we have to go to where the ball's going. We can't just stick to where the ball is at right now. That is not an opinion.
Yeah, I'll add, and maybe even dive into some of the opportunities we see, but everything we do on the impact side is focused on market rate, and the energy transition has been there as an opportunity for us all 10 years. We have the flexibility that we don't have to do every type of impact along the way, and I also don't have to, you know, even as much as we like energy transition, different times, different regimes, we don't have to invest in every type of asset class or risk profile to go forward. And so, whereas I think that the infrastructure equity returns looked really good kind of 10 years ago, right now we're moving into a little bit more of a barbell approach as we think about energy transition. We really think there's some great opportunities, and Anna and Kunal will kind of mention around this, around debt. There's so much that needs to be built, and there's some really great credit underwriters there who they just have to kind of focus on the execution and getting their payback and being competitive on the rates. And a lot of them also, just to throw this out there, are able to do project finance with a floating rate. So you don't have to take interest rate exposure or base rate exposure on either side of that. And the biggest risk you usually have on that end is having refinancing risk, where things work out and you might have to redeploy. But again, your IRRs are probably looking really competitive. We've also moved into early stage venture. My favorite thing about having covered just traditional energy and fossil fuels for a lot of years is it gives you a great roadmap of all the things you should be investing in venture and private equity, because those guys love to point out all the reasons things won't work. And then you have to just take that back and say, okay, but who are the people who are providing these innovative solutions to these roadblocks? So there used to be a question about intermittency. Okay, well, that pointed us towards battery storage and also some of the technologies that were needed along the way to deal with that problem. We also now see that we have a grid that is probably not greatly equipped to bring on all these renewables. Well, you're able to find people who have infrastructure service experience, and you're also seeing, again, technology solutions that are coming into that that are an interesting place to play. The same thing around materials. A lot of us are worried about, you know, mining and all this, and how are we going to get everything in there? Well, there's material science people out there, maybe it's not discovered today, tomorrow, 10 years, but there might be some really great things that unlock renewables in the same way that fracking unlocked lower priced oil and natural gas over the last 10 years. So you can always go and draw parallels, and it's a good time to spend you know, talking to the critics, because they'll also lay out some of your very best opportunities, not just in the energy transition space, but across all different types of impact. And if you're able to solve really big problems, that usually turns into really big returns. So you don't have to have that trade-off.
Erica? Sorry?
Are you all differentiating between climate adaptation and energy transition in your portfolios?
We technically don't. I mean, I also look at a lot of groups that focus on energy efficiency on the same way. So how can we reduce our total energy impact on the production side, like you mentioned? But also, I think we have a keen awareness of how are these different types of projects going to be interacting with the environmental space around them as well. And that's part of why we like nearshoring, because if you're doing less cross-ocean or transocean transport, that also works well on that side too.
I think it's a good question. Sorry, real quick, just to point out Erica's question, because a lot more money's gone into mitigation, a lot more emphasis. And yet adaptation is going to be, especially in the next decade, really at the front. And obviously government support, philanthropic support, you know, catalytic support, but is there an investment thesis in there? So keep your eyes out for that. We can define that more on the panel. But you think about, we want to kind of drive down carbon, right? So we're gonna mitigate it. We're gonna hopefully capture it at source. We're gonna shift to other kinds of energy systems, and we're gonna try to sort of get the world ready or adapted or more resilient as we go along, which has to do a lot with shoring up things and infrastructure and efficiency. And then also there's a big emphasis now on we're gonna have to remove more carbon from the atmosphere than nature can. So how do we do that? And there's a lot of emphasis with that as well that is from nature-based solutions to more mechanical solutions, and direct air capture to carbon capture out there and mechanically. So I think it was a great question, and we can continue on that. But Anna, I think you were going to say something.
No, I was just going to say, I think adaptation and resilience, right? The original word sustainable, right, in an investment context meant that you were investing with management teams that were actually planning to be resilient and adaptive to whatever environment, they have to function in and be competitive in 5 to 10 years, right? So around the investment thesis, it is essentially the investment, what investors should be looking for in general.
Mm-hmm. And I think you make a good point. I think what's happened is that what frustrates me is that the investor mentality has become so short-term focused.
Yeah.
Right? It's like the next 90-day period. If you sit on the hedge fund manager calls, the questions they ask corporations about what's your 10-year vision, what's the path to sustainability, but most of them hold those positions for less than 2 years.
Yeah.
Right? So I think the long-term alignment of incentives is something that people have lost sort of traction of.
100%.
I mean, I'll say for us, I'm so happy to hear this conversation because I've heard the earlier conversations when this was not the thing that it was, right? This is what foundations do. 20, 30, 40, 50-year investment horizons. We have catalytic capital. I tell people all the time, we are not the big boys in the room. I used to work on Wall Street. Foundations have very little money comparatively. We have to recognize that, so we try to be catalytic. So we want to see other capital come in. That's why I'm loving the conversation. But we also want to make sure for us that capital is also landing in place in the ways that we hope it does. When we think about climate adaptation right now, we're thinking about how do we support cities in the tax-exempt bond market.
In the what?
In tax-exempt bonds right now, particularly cities like New Orleans, a special city to us, and water. So that's why I asked the question about the differentiation, because sometimes folks don't, we do. And we're constantly trying to think what is the systems level change there to try to drive more capital to that.
Yeah, and I think we can riff on that about how to get more capital in, but I do want to stay a little bit on this topic. Does everyone understand what catalytic capital is, quote unquote? Some not. Maybe you could talk about that a little more, because this is a layer of capital that foundations, whether or not they're institutional foundation or private foundations and or others, can come into at all sort of levels of investments. We've seen it in just climate projects, climate venture, climate funds, but also in work on place-based initiatives. Very important because it's going to help de-risk. It's going to create buffers, first loss, bring more capital in all around it. And so if you are in that category and you want to learn more about it, certainly there's experts on the panel. But Erica, do you want to add to that? Because you guys do a lot of work in this.
Yeah, I'll say really quickly. So Crescent will be 100 years old next year. And so we've been doing this for a while. My practice is one of the oldest and probably one of the largest social investment practices out of the legacy foundations. So out of the top 10, our peers are like RWJF, Ford, so on and so forth, right? Because you do have to have a team built out to do this. And when we think through being catalytic, we look at the systems level change. What is the base issue we see right now? And then what do we need to try to drive? Is that supporting, because we are totally nonpartisan as foundations. But when there are policies that support the people that we support, we definitely want to try to figure out how we can be a part of that, right? So we tend to start with the policy piece, but on my side, we're squarely in the economic space, and how do we use the capital that we have, equity, debt, and guarantees. And guarantees we talked about a little bit more, which is part of the foundation, our endowment base, to drive capital to things. So sometimes we de-risk, sometimes we'll be the first ones, and sometimes we will invest in a venture capital fund or something else that somebody else won't, because I have a different risk profile. I still need my money back. I'm not a grant maker. But I can be judged, actually am judged by what is the impact that I have first. We can't really do widgets with our work. So how we look at it is 5, 10 years down the line, did somebody else put money in? Is there other leverageable capital? Did we change the system of capital coming into a thing? Because again, we are not the big ones in. So that's how capital works, is what can we do from our position, risk, influence, to try to drive a thing that brings in other capital, because we just don't have a lot of it.
And traditional philanthropy was in the stack and still is, but this is something different, because this is really attracting in capital around it, or you're using actual investment capital that's catalytic, but from a sort of a philanthropic or a foundation. Very important. And I was with some social venture entrepreneurs this weekend in climate, and some of these things are coming out were absolutely amazing, but they're going to need patient capital. That's another thing. And it may or may not fit your portfolios, but if you do have portfolios with longer term time horizons, there are a lot of ways to put it or consider it now. But you have to be with it a little bit longer than a convention, which is maybe a hedge fund. Pause for, here I have a question. Great. Right here. I guess we have a mic.
Thank you for this. If the panel would comment, please, on what measures are being taken to ensure that the energy transition is just, fair, equitable, inclusive?
That's perfect timing because it was our third question. Thank you. And let's go into that now. And I think we're going to start with Erica. So.
Sure. So I would always say go to kresge.org, KRESGE.org, because our PR people are fabulous, and they're always putting out all the information, which I cannot even get to it all. I will say we are really looking to the Justice 40 initiative. We're really looking at GGRF, as we mentioned before. But we're trying to take it out of the context of just the communities that we support as customers to how are they part of the economics. So when I mentioned like the manufacturing fund, right? That is part of it because we see this as an economic opportunity. So we want to make sure that they're actually making money as well as spending money. We're also thinking a lot about diversity in terms of who's at the table. There are a lot of fabulous ideas out there. There are a lot of entrepreneurs that are really doing some interesting things. We've invested in Posigen and a few other companies directly, which is not common for PRIs because us and equity don't always get along because of regulations, but we're having to go there because the sector is that mature right now. That's what's called for. And so we're constantly pushing every investee that we have according to what we're trying to drive and change. Where is the community as a part of this? What are your considerations for the companies? What are your considerations for your exits? That's a big thing that I'm always thinking about, particularly when it's a diverse company as well. Do they get to retain any of the wealth? How does this money circulate in the community? How do we know that there's what's sometimes called a circular economy? Not always critical, but we like to see elements of that as well. So we set different standards for every investment that we do, and then that goes through our investment committee as well. And we also tell the IRS what we're trying to drive to as well. So, we have to hold them to it. If we don't meet that, we are at risk. And so I'll add that element as well. People think we can fudge it. We really can't fudge it without potentially losing our tax-exempt status as a foundation.
That's
I think on that end too, if you're an allocator, a lot of that responsibility sits with you. Which groups are you choosing to partner with? What type of questions are you asking in due diligence? Erica laid out a really great framework of things you should be asking about. You should be pushing questions around their supply chain. Who are the service partners that they're picking out? What are they doing with the communities, especially if they're doing large infrastructure? How are they acquiring the site? What are they doing in terms of having that inclusiveness? And that doubly counts if you're doing any of this in emerging markets. Emerging markets cuts both ways. It can be incredibly extractive, or it can be incredibly catalytic, because when you think about job creation, increasing overall electrification and what that means for financial inclusion, health outcomes, education outcomes, and really invigorating an environment. We've seen that with some of the investments we've had in Africa especially, but you have to make sure you're picking the right partners along the way, and ultimately that sits on our shoulders as allocators and how we're going through due diligence.
There's going to be huge onshoring effect now, too, in the United States in this.
If I can add one other quick point, I'm always looking out for, do your returns of what you say that you're going to deliver actually seem realistic? Because I know that if you don't have realistic terms, or if I'm somehow putting something on you, you're going to do a lot of things, cut some corners, do some things with your workforce, do other things that are going to destabilize my investment. Like, thankfully, we're very long-term, and so we can think through things differently than other investors, but that's a big, big, big indicator for us. What are you doing to get this fabulous return? And does that line up with the goals that we have as well? Because sometimes I can take less of a return if I know that it's going to be more stable because you are doing this from the ground up and making sure that it's sustainable, that it's just, and all the other things that we like to see.
40% of the IRA in certain clean energy investments have to flow to disadvantaged communities, by the way, and to support economic development, workforce, job training, those kind of things. So this is really written in. So if you're going to be in it and then you use the tax credits or other incentives, it's got to have to support these areas. Let's go to another question over here.
Hi, I'm Tom Burgandy. I'm a managing director at Rescura. We're the largest emerging and frontier market domiciled investment consultant. We advise on about $200 billion of pension fund assets. Our clients are primarily African pension funds, and we're really interested in impact, and our clients have invested over $75 million into the African Women Investment Fund. But my question is to touch a little bit more on what Tyler was getting to. There's tremendous demands in emerging markets, and how can we, because our capital base, it isn't big. How can we catalyze more investment from the U.S. into places that really, really need it on a greenfield basis like Africa?
Yeah, I mean, this is, I think, one of the biggest structural issues, that we're going to face in this transition, right? So the average investor in the U.S. has a less than 2% allocation to emerging markets in the public markets. Their venture capital, private equity allocation to emerging markets is even less, way less than 1%. I'd be surprised it was 0.5% of their total portfolio. And when you look at then just the relative value, unfortunately, right? I'm not supporting this, but right now, the U.S., if you were to pick the U.S. energy sector or the emerging markets, right, as a relative value trade, unfortunately, on a risk-adjusted basis, right, there's a big difference there. And so there is this structural impediment to and a very strong behavioral issue, right, in developed countries around the allocation to emerging markets and what we need to do there. And I think that's been, and as an investor in emerging markets, I'm often seeing pools of capital in more commercial rate, say private equity firms or more commercial rate funds that I think or define themselves as actually catalytic capital. And so I'm a bit confused, right? I'm not answering your question. I'm just unearthing, I think, a conversation that I don't have an answer to, but that it's a really big structural problem, which is when you have the very organizations that are supposed to be providing catalytic capital within the emerging markets are sitting in commercial rate strategies alongside me, who is a commercial rate investor. That's my mandate. That's a really, I think we have to wrestle with that as, right, as an industry, right? Because changing asset allocation grids for everyone in the developed world, right, is a bit difficult, right? But thinking how from a bottom up we can do what Kresge's doing in the U.S., but in the emerging markets in this context, but the good thing about the emerging markets is that they have to newly build a bunch of infrastructure, right? This leapfrog effect, et cetera, that's always been talked about. But they do actually have an advantage, both technologically and from a real asset standpoint, to build in this way. But the capital flowing is a huge issue, and thank you for bringing it up.
Yeah, and I think a big part of why you're not seeing more funds launched there is, and this goes directly to your point, Anna, is people ultimately worry about the exits. Who's trying to buy these long-lived assets, or even some of these really good innovative private equity type companies, and who wants to have that exposure? And again, that all goes straight back up to our IC committees and what level of exposure we can take in the public markets long term, or Maybe it's going to be those pensions want to be the end buyers at the end of the day of these long-lived infrastructure assets, and there might be some really good matching on that side. But we sit in the same boat of it feels like there's not a lot of managers going out there. Also, most of the large infrastructure funds are all being raised focused on the U.S.
Yeah.
and Europe. And in some ways, I'm like, but you could be getting some really outsized returns because there's not as much competition there if you can execute on it. The problem is it's really hard to do that, to execute on that. And that's why I want to see some of the big names go there with dedicated.
Right, and in infrastructure, you get into government contracts.
Exactly.
And that, for an investor, a commercial investor, is like the biggest red flag in an exit strategy,
But-
right? So it's a problem that compounds on it.
Thank you. Let's, I think we have time for one more question. Way in the back?
Yeah, hi, Andrew Sewo, New York State Common Retirement Fund. How do you see the definition of sustainable investments evolving, given that we've seen how ignoring bright lines has caused chaos in the ESG space, and now that nuclear and natural gas, 10 years ago, those were bad words, now folks are realizing that that's going to be a part of the transition. Now there are all these global conflicts. And so a lot of funds that are launching now, there's almost a sense of the arsonist is coming back as the firefighter. And so when you're looking at these strategies that have hydrocarbons, can you slap a sustainable investment label on them or not? That's my question.
Thank you. And it's a big topic, and especially right now, more here, but also elsewhere about, greenwashing and ESG, et cetera. Why don't we just use this as a last word for each panelist? How are you thinking about sustainable investing over the next period? How's the definition changing for you or evolving?
I'll give a quick 30-second update. I started in the sector 15 years ago, and at that time, if I told anyone I was an impact investor, they looked at me and then walked away usually. Because it wasn't sexy, no one wanted to work with it. There's a point where it was called patient capital, then became clean technology 1.0 bust. The name's gonna keep changing. Ultimately, I'll be happy when the word sustainability disappears, because it's just good investment sense. In the long term, it's like the internet. In the early 2000s, every investment bank had an internet team, right? You made internet investments. That doesn't exist anymore. Internet just pervades everything. So that is my bet, in that in 20 years, hopefully, this is not a separate asset class. This is not a new theme. This is just the way of investing.
Yeah, I mean, for us, we already exclude investments on both the public and the private side that go into hydrocarbons. And then when I'm looking at something on the climate side, we're trying to, not to be catalytic in the way we've been talking about it, but we want to invest into those things that we know are really going to have a magnification on it and not necessarily just be a bridge, because we realize there's plenty of capital to do that. So that's not our role within the environment at this point.
Yeah, I would say, this whole Kresge approach, my endowment team, like I said, does energy transition. They have considerations for whether or not it harms the environment when they do an investment, but I don't think they really look for sustainable investments per se with that. I would say this is the same thing at Kresge. On the PRI side, we look for, is it gonna harm? But we're not necessarily looking for the thing that has that actual definition. It's integrated into everything we do as a consideration at this point.
Yeah, and I would just say this conversation, agree, whatever word you want to use, it's about cost. At the end of the day, this is about lowering your cost of inputs, right? And security, like interdependent, right? And that's what's going to drive this conversation, whatever you want to call it. Now, there are different views about what is secure. And certainly the nuclear debate is probably one of the largest questions out there about, again, which I am not smart enough to have an answer to because I'm not a nuclear engineer. But I think that if you break this whole thing around sustainability down, what the investor is really looking at is right now cost and security, and that's what's going to drive this industry.
Well, this is great. We actually just hit the time mark. Anna, Erica, Kunal, and Tyler, you guys are great. I encourage everybody to reach out to them. They're experts in this space. Ask questions, make the contacts. They were fabulous. Let's give them a hand. And Phenix as well. Thank you.